part two of an earlier live session that was rudely interrupted by some internet connections here and there, but we have to keep fighting. That is also an indicator that even in your personal finance journey, things will not always be easy, but you need to keep struggling, you need to keep fighting. You don't get knocked down once and you leave it at that. You have to keep trying. Some months you will not feel like saving, some months you will feel like consuming the whole chunk of your salary, but you'll have to keep fighting, you'll have to keep trying again. So let me reintroduce this session again briefly. I had made an introduction in the other session, but I have to do it again. I said that majority of the times that you meet people talking about personal finances in the internet, they talk speaking to those people who are already established, those people who have been following them for quite some time, and we tend to forget those people who are just struggling to start their journey. We forget that young man, that young lady who has just been employed and they have just earned their first salary. They don't know where to start. They don't know where to start savings. So this session is for that group of people. And the title of my conversation was the most common investment vehicles in Kenya. So we are just doing an overview of once you get that your first salary, where is that place that you can get to deposit your first 1,000 savings, your first 10,000 savings. So that is the kind of a conversation that we are having in this session. And I had already discussed two in the earlier session before I was cut short by internet disconnection. I had discussed about fixed deposit accounts and I had discussed about SACCOs. And allow me to dive into the third one. If you had not joined us in the earlier session, just go back and search the same title. Yeah, you will see the first episode or the first part of the presentation. You'll be able to see the first part of the presentation, but in this second part of the presentation, allow me to dive into money market fund, and welcome all aboard. Now, and keep subscribing, turn on the notification bell so that anytime we get to upload a video on personal finances, we do that every day 7 p.m. You'll get notified and you don't get to miss any of them. So keep tuned. Now, let's talk money market fund. If you're in Kenya, I'm sure you have heard about money market fund. It is the song that everyone sings to a point that made people think that it's a scam or it's a get rich quick scam, but it is not. A money market fund is the most investment instrument or the most financial vehicle that I would recommend to that person who is just starting their personal finance journey. It is that instrument that I would recommend to that person who has just been employed. It is that product that I would recommend to that person who wants to invest their first, to save their first 5,000. So that is the kind of a product that I would recommend. So money market fund is not a get quick rich scam or scheme. It is not a scam, but it is just an investment vehicle that allows you to keep your savings bit by bit. So keep subscribing, keep turning on the notification bell. And we say that a money market fund is a financial product where funds are collected from different investors to form a big pool of funds. The funds are then invested in different instruments and returns are redistributed back to the investors. In the earlier session, I discussed about fixed deposit accounts that are given by the commercial banks in Kenya. And I mentioned that the interest rate might depend on the amount and the period. And of course, the higher the amount, the higher the period. And if you go there with your 50,000 in the bank, you want a fixed deposit, you will not have the bargaining power of the interest rate. What the bank offers is what you give. But if you put your 50,000 in a money market fund, someone else does that, you get to create a common pool. you start talking about millions, you start talking about billions. When going to seek an investment venture, you'll even have the negotiating power to say what kind of returns that you want. So money market funds are majorly offered by commercial banks and insurance companies, especially insurance companies. They are good at it. They collect funds from different investors, small funds from different small investors, to create a pool to a money that we are talking about, tunes of millions and billions, and majority of it is, but you might not be able to invest directly into the treasury as you start your journey with your 5,000, but you can do that with a money market fund. You can start with a money market fund and walk up the staircase. So the interest rates change on a daily basis and are availed in the internet, in the papers, everywhere. You should be able to see the interest of your money market fund. So keep subscribing. So MMF are mainly offered by commercial banks and insurance companies. I had already mentioned that. Interest rate is calculated on a daily basis and invested in on a monthly basis. So the interest that your money earned in the month of January will form part of the principal in the month of February. The interest that you earn in the month of February will form part of your principal come to the month of March. So interest earned on the MMF is subject to withholding tax. So the government has to take a percentage, currently set at 15% in Kenya. So 15% of the interest that you earn will be collected by the government. So I said this is just an overview, but you can check a full video for more than 1 hour where I have explained everything in details about money market fund. So this is just an overview. I'm just mentioning, but just go to this channel. The name of the channel is Finance Focus with Andrew, and just search money market fund. I have a video that is more than 1 hour where I have explained money market fund into details. I have a playlist of my videos that I have talked about a money market fund. So when I mention something here, feel free to go on the same channel, Finance Focus with Andrew, and you will be able to see a lot about these things that I'm mentioning here. I have talked about them in details. I'm just giving a highlight right now. Allow me to go to the fourth product that you can consider as an investor who is just trying to figure out their personal finances. Let's talk Treasury Bonds. And Treasury Bonds is simply you lending the government. We know our country with taking a lot of debts. Even when our presidents get to travel to China, we always give answers to ourselves that he has just gone to collect another debt. Now, other than that debt that is collected from foreign countries, the government also borrows from its citizens. Yes, the government borrows from its citizens, and that is done through Treasury Bonds and Treasury Bills. But this right now we are talking about Treasury Bonds. That is done through Treasury Bonds issued through the Central Bank of Kenya. So, Treasury Bonds is simply you lending money to the government, and the government will give you back your money with some interest. So, a Treasury Bond is a long-term investment vehicle where government borrows money from the public and the investors earn interest in return. This is a long-term investment vehicle. Treasury bonds run for a period greater than 1 year. Different bonds have different time to maturity. Every treasury bond pay interests on a predetermined interest rate. Interest is paid in 2 installments per year on some predetermined dates. Some bonds are taxable while others are tax-free. Every bond has a unfortunately, the internet seems to be disappointing again, but let's move on. So, we have said treasury bonds is simply lending to the government, and you get some. You'll find a video that is longer than 1 hour where I have discussed in depth about treasury bonds. the main disadvantage with the treasury bonds to someone who is just trying to figure out their personal finances is that you need a minimum of 50,000 to begin, and you might not have that 50,000 in your first paycheck. So that's why I said my money market fund is my preferred vehicle of starting your personal finance journey. Then you come to graduate to other products such as the treasury bonds and treasury bills as time progresses, as you get to mature financially. Because you need 50,000 to start on treasury bonds. You might not get that in your first salary, because I believe I'm talking to the common Kenyan man. Now let's move to treasury bills, and I simply like saying that treasury bills are the short brothers and sisters in the family of government securities. Government securities are treasury bonds and treasury bills. So treasury bonds are the long brothers because they are investments that are longer than 1 year. Then treasury bills are the short brothers and sisters in that family, and they are all good, they are all important. So a treasury bill is a short-term borrowing instrument issued through the Central Bank of Kenya to raise money on short-term basis. That is period. The maximum period is 1 year. So treasury bills are short-term investment with maturity periods of 81 days, 192 days, and 364 days. I forgot to mention that nowadays the government seems to be borrowing a lot because they are reopening treasury bonds every other month. So it means that every other month you have an opportunity to invest in treasury bonds. So treasury bonds are reopened like almost every month nowadays. But when it comes to treasury bills are floated on a daily basis. So every other week you can be able to invest in a treasury bill in Kenya. Now let me go to the other thing that you can consider is someone who is beginning their investment journey. That is shares in stocks. And let me mention that shares and stocks seems to be so common in some earlier years, in the ages of our grandfather and maybe our fathers. And one of the reasons why I think shares were most common, I think shares were the most common financial. So I was saying that shares were like the only financial instruments that people knew about in some earlier years. So anyone who had investment in those days, if they were not investing in land, they were investing in shares. And that's why you find that those people who get dividends are majorly those quite aged people. People in our generation are not so much into shares. I also think that we don't have the patience that is required when it comes to shares, because shares do not materialize in months. They might take years to give you capital gains. They might take some years for you to make some profit, but it's still an avenue that you can try consider as you go up your investment journey or your personal finance journey. So a stock is a financial instrument representing part of ownership in a single or multiple organization. If I buy Safaricom shares today, it means that I own part of Safaricom. I own a small portion of Safaricom. When ownership of Safaricom is mentioned, I'm there. There are around 65 public limited companies in the Nairobi Stock Exchange from which buy shares. So we have 65 companies that you have a chance of owning because they are already listed in the NSE, that is in Nairobi Stock Exchange, where you can buy shares from. So investors get returns through dividends or capital gains. So investors in shares, you either benefit from capital gains, that is when shares increase their prices, you get to sell, and dividends. Dividend is simply after a company have operated for 1 year and they make profit, that profit belongs to the owners of that company. That profit belongs to the shareholders of that company. So it is distributed among the shareholders. And now that you are a shareholder of the company, you get to get a portion of the profit. So shares is relatively risky venture as their invested capital is not preserved. In some instruments such as the Treasury Bonds, the money market fund, the SACCOs, the amount that you have you have contributed is in a way protected. You are not likely to lose it, the money that you contributed. But when it comes to shares, that money is not protected. I like giving the example of a very famous company in Kenya, that is Safaricom. Someone bought Safaricom shares at 40 shillings in the year of the Lord 2022. Right now we are in 2025. Safaricom is trading at around 23, 24. And it has even tried, it has improved from the ranges of 12, 13, 14. So you can see the kind of loss that you can incur when it comes to shares. So don't take your first salary and run to NSC to buy shares. Vanish anytime. So don't take your effort to invest in shares. Don't, because you might not be able to realize the profit soon. So in shares, deposit that money that you feel that maybe you don't need it too soon. So when shares appreciate, the investors gain, but when shares depreciate, the investors loss, get some loss. And I have given the example of Safaricom. Again, I have done a full video on shares, more than 1 hour just explaining shares, like I'm explaining to a 5-year-old kid. So just go to this channel, Finance Focus with Andrew, and search about shares. I have a video of over a whole hour explaining everything about shares. I have a playlist of quite a number of videos talking about shares, and currently every Wednesday I drop a video on shares on the NSC. Like every Wednesday at 7 p.m. I will post a video talking about shares, talking something about shares. Even if I will just come and tell you that the NSC is still open on Wednesday 7 p.m., I have a promise with you that I will always post something about shares. So that is why it is important that you need to subscribe, turn on that notification bell so that you get notified anytime that I get to post something about shares. That is on every Wednesday at 7 p.m. It's a deal. I think I have discussed the 6 most common investment vehicles. When you go to the channel, we have some more things like special funds. You'll find them in the channel. But at this point, let me move to something a bit different. Okay, not really different it's still in the line of your personal finances, but it is something that is not so much accepted in Kenya. I don't know why, but maybe we are not yet mature enough, but maybe with time we will be able to accept, and that is insurance investment product. Anytime you hear someone talking about insurance, if it is not, let's say, when you talk about insurance in Kenya, what comes to your mind first is that car insurance, and it's simply because it is compulsory. If it was not compulsory, many people will not have even that car insurance. But it is important to note that insurance companies, other than the property insurance, that is the kind of vehicles, houses, property, they also have what we call life insurance. And life insurance is all about, okay, it's not life insurance because no one can insure against death. Death is, we are all sure that we will die. So dying is not a question of if, it is just a question of when. So it is called life assurance. Because we are sure that you will die, so you cannot insure against death. So the life assurance part of insurance companies offer what we call savings products. And they come with some returns and protection. Protection is the main part. So there are some insurance policies that you can consider, especially those people with maybe some young families. Think about it. When if you get to, okay, I don't know whether it will sound so bad, but what happens if you die right now? What will be the financial status of the people you leave behind? What will be the financial status of that young lady that you leave behind with a kid? If you had an insurance policy, they could get some benefits that will help them foot themselves financially again. So I don't consider investment product as so much of savings, but they are important for protection. And I have said, especially for those people maybe with young families, don't leave a whole kind of desperation behind. There is something that you can do about it. So let me read my presentation here just for just an overview. So insurance companies are majorly known for covering against risks such as fire, theft, and accidents. Insurance also offer products that offer solutions to some of challenges in life. So such challenges including owning a home, educating your children, and living well at old age. You can be sure that some of the challenges that you have to deal with at some point of your life. Number one is owning a home. Everyone have the plan and desire to own a home. Educating your children, you need to give them some good education, because I believe we still believe that education is still some key to some doors. Being educated is not bad. Nowadays skills pay better, but you need your children to have that basic education, and you also need to live well at old age. At some point, it will come to a point that you will no longer be able to work, but you will stop earning, but your needs will not stop. So what will you do at old age? So those insurance products that we are talking about come to solve such challenges of life. They will help you navigate your children's education, your retirement, such. So I think it is the high time that we need to start changing mentality about insurance as Kenyans. You see, the penetration rate of insurance in Kenya is still at a single digit, 3-5%, and that is not right. So this is made possible by insurance savings plans such as the endowment policies and annuities. Let's see whether I get to mention something. So endowment funds are a type of insurance which combines savings and life assurance component. I had mentioned that. Each policy have defined time span for maybe 10 years. An individual pays premiums and benefits are paid out when risk occur, that is in case of death and maturity. So the endowment policy, this is how it works. Just a brief explanation. You make contribution in terms of premiums. So the monthly contribution that you make are known as premiums. Maybe you say for 10 years. And you are making a contribution of 2,000 per month. Now, you will get the benefits fully. Of course, there is a sum assured, an amount that you have been told you will get after 10 years. It's either you get that amount at 10 years, or someone gets that amount in case you are no longer there. And by being no longer there, I mean dying. You need to nominate a beneficiary. So if you die before the 10 years, someone will get to benefit. And that's why I was saying, maybe someone with a young family, you have your wife as the beneficiary. In case you die before the 10 years, they will get some benefits. They will be able to do something about their finances before now they get to stabilize. In case you are still there, and we hope at the end of the 10 years, that's nice. You'll be able to think again. And the example I see that I had placed in my presentation, I believe it is when the Kenya police were being deployed to Haiti. Say, for example, a police officer about to be sent to Haiti. the gangs are a menace and the police life is on the line. So he or she can decide to subscribe to a 10 years endowment plan. In the unfortunate event of death in Haiti, a death benefit is payable. In the event of survival, a maturity benefit is payable. So it cuts the two ends. If you survive, well and good, you'll get your benefit. If you don't survive, someone else will be able to benefit. That is someone who was relying on you financially. So that's why I propose that insurance products are better for those people who have families, and especially young family, a young wife, a young child, such. Then we also have annuities. So annuities are vehicles to provide regular income stream after retirement. An individual can pay a series of premiums or a lump sum that will be received monthly, or a lump sum that will be received monthly, quarterly, annually, starting from a later date. So when we talk about annuities, annuities is something that can help you survive on retirement. It's either you contribute for an amount for the years that you are working, then once you retire, they will start paying you back the monthly contributions that you are doing, of course with some benefits. You can also do a lump sum, and an annuity is something that someone who has gotten a windfall can adopt. You see, let's say a good example is places where government gets to develop their projects, maybe a road, a dam, such. And your land is taken by the government and you are paid some legal settlements. Maybe you are given 5 million, and the maximum amount of money you have ever touched in your life is 50,000 or it's 10,000. The chances of you misusing that 5 million or 10 million are very high. Some of the options that you can consider is approaching an insurance company, give them that lump sum amount, and you agree on the monthly contribution or the monthly payments they will make to you for a particular period of time, and most probably the period of time can be until death. So the example that I had given about annuity in my presentation was an example would be Eric at 30 years would enter into a contract to contribute a monthly premium of 3,000. Then from age 60, when he retire, the insurance company will pay 10K per month until Eric dies. Alternatively, at 55, Eric has 2 million. If Eric decided to buy an annuity with 2 million and enter into a contract with from the age of 60, when he retire, insurance company will pay him 10K per month until death. So I have said that you can buy an annuity either with monthly contribution or with a lump sum. And we say that different insurance companies have different insurance companies structures their product differently to suit the needs of their client. For example, different companies may provide education policies with different terms. Other insurers may include whole life policies that focuses on providing protection for dependents. Maybe you can have an insurance policy that you have agreed that you personally will not benefit regardless of how long you live in this world. It will be meant for those whom you will leave behind. Those are the kind of policies that we call whole life endowment policies. You contribute for the entire of your life, and who gets to benefit is that someone whom you will leave behind once you die. We are almost coming to the end of my presentation. Keep subscribing so that it don't end there. We don't end engaging at this point. I will keep engaging because once you subscribe, you'll get notifications every time we upload a video, and we do that on a daily basis. So let me say something as I conclude. Some essentials. That is how I had titled my page of presentation. Some essentials. Number one, number one essential on personal finance is understanding your cash flows. So understand how much you get, understand how much you spend, understand how much you invest. Don't be that person who get paid and in 2 days they have squandered the entire salary. They cannot explain what they did with the salary. That is what I mean with understanding your cash flows. So risk versus return. Investment is all about a balance between risk and return. So don't put your money where you have risk but you are not getting return. Then don't risk your money so much chasing a higher return, because especially in this country called Kenya, we have more scammers than real people. You might be promised good return, but the risk is too high and you end up losing your money. So as you start your personal finance journey, don't be so much into return that you forget even to do some background checks for some investment. You forget to do some due diligence, which is very important when it comes to investments. Remember, we are talking about your hard-earned money. The other thing is diversification. Diversification is simply not putting all your eggs in the same basket. That's why we have the different products. Don't put all your money in a SACCO. It might collapse. Don't have all your money in a bank account. Your account might be accessed by a fraudster. And like have different products. Diversification. Don't put all your eggs in the same basket. That is it. Then automate your savings. If especially for those people who are not financially disciplined. By financially disciplined, I mean that person who at the middle of the month before they get paid, they really have good financial goals of how they start saving at the end of the month, how they will save in a circle, how they will open a money market fund account at the end of the month. But the moment they get that paycheck, reasoning erupts from their mind, and they activate the you live once mood, and that is how they get to waste the whole salary, and they go back to the same story. One of the things that you can take advantage of is the digitization that we have, that you can be able to instruct your bank. Immediately my salary hits my account, deduct 5,000 and set it to a SACCO account. That's what I mean when I talk about automation of savings and investment, especially if you are not good in financial discipline. Consider automating your savings. Otherwise, you will live at the same place saying that I will start saving next month, I will start saving next month, and that might never happen. So those are some of the essentials of personal finances. And I concluded this presentation with one statement that I'll still use, and say that the best time to invest was yesterday, but the second best is today. So the best time to start saving, the best time to start investing, the best time to start taking your personal finances seriously was yesterday. But in case you did not do that, the second best time is today. So that was my presentation to that group, and that was my presentation today to you. And I go by the name Andrew. My channel is Finance Focus with Andrew, and I have said that I post a video on personal finances on a daily basis. At every 7 p.m. on this channel, you'll find a video talking about personal finance, something that is related to personal finance. In case anyone who is watching me have a question, can be able to put the question on the comment section, and we get to address it. In case you come watching this video later and you have a question, still drop it on the comment section. I'm able to follow up on all the comments on my post. So be sure if you ask your question on the comment section, I'll be able to see it. Otherwise, subscribe, turn on the notification bell so that you get notified anytime we post a video related to your personal finance. So even if you think that your personal finance don't matter, even if you think you don't have to think about your personal finance, you'll be lying to yourself. So the earlier you come to the realization that you need to work on your finances, the better. So the earlier you realize you need to work on your personal finances, the better. And I'm here to walk the journey with you. I'm here to give you the information that you need, because earning money and having money is one thing, and managing that money, it is the real test of time. So that is it. Subscribe, turn on the notification bell so that you get to be notified anytime I post a video on personal finances. When I talk about personal finances, I talk about anything that concerns your money. Sometimes you'll find me talking about love, but I'm not talking love from the emotional point of view, because I'm not an advisor on matters love, but I'll talk about love from an angle of finances, because it comes to some age at your life where every decision is a financial decision, including dating, including marriage. All those are financial decisions. So if you find talking me about love on this channel, I don't think that I have deviated from my purpose, that is personal finance. It is because it gets to some age where every decision that you make in your life has a financial part of it. So that is it for my presentation. I hope the conversation does not end at this point. Hope our connection does not end at you watching this video. Subscribe so that we will keep engaging after this. Otherwise, it was nice having you on the session, and I look forward to learning more together with you. Thank you.